Good evening. Thank you all for joining us tonight. My name is Russell Lindsay, and I'm one of the partners here and CPAs here at Lindsay Crabb & Associates. So I see a lot of familiar faces and some new ones. We're excited to have you here with us tonight. And the purpose of our get-together is to just spend a little bit of time and talk about the new tax law reform that took place at the beginning of this year. It's the largest tax reform that has taken place in the last 30 years. So a couple of points about the tax update and changes are there's an exception to about every new law. So the purpose, as you will see as we discuss, the purpose of the new law was to simplify the tax code. Wink, wink.
Yeah, right.
And most of the new law is temporary, meaning that these laws are in place this year in 2018, and they go through the end of 2025, where then at the end of 2025, if no other laws are passed, it goes back to the way it was last year. So, so our time together tonight, we are going to try to have you out of here at 7:30 at the latest tonight. Okay, so we will stick to that. We did this earlier this morning, and we got out about 10 minutes early. What are some of the laws that were in place last year that have gone away? What are some of the new laws? And then some ideas at the end of how to plan. And most of our clients come to us trying to figure out how to pay the most amount of tax as possible, but some of our clients want to figure out how to minimize their tax. So we will give you some ideas of, if you fall into that category, of how to minimize your tax under the new law. I'm curious though, typically when we have clients that come to an event like this, they've got something on their mind or something that they're hoping to answer. So if anybody has any questions now, I'd like to put them on the board. I started with one of the questions we had earlier. Can we file on a postcard? But if there's any other questions that you have now, I would take them. And if you're not ready now, because maybe you're not sure of what questions you might have, as we're going through the discussion tonight, we would ask that you just raise your hand and ask the questions, because our goal is to provide you guys with some helpful information on the new tax law. So like I said, our goal is to give you clarity. We're going to cover some of the highlights. The explanation and interpretation of the law came out last Thursday, and it's 184 pages. So we're not going to spend that much time tonight going through all the detail. We're going to try to cover the things that are most relevant to you. Some may apply, some may not apply, but we will do our best to cover most of the things that apply to the vast majority. As we leave here tonight, you may find yourself going home or thinking over some of the things that we've talked about over the next couple of days. And not to worry, we have two of our CPAs that have set up time on their schedule, Susie Crabb and John Gibney, over the next month and a half, that if you'd like to come in, each one of you, your situation is unique and different to your family. So if any of you all would like to schedule an appointment to hone in on the details of your specific situation, we will have the teammates available to schedule follow-up meetings over the next month or two.
At a discounted fee.
At a discounted fee, that's right. The discounted fee is $150 an hour. Before I turn it over to some of our teammates, at the end, we will leave time for questions to make sure we answer all these questions that don't get answered during the presentation. And then we've got some exciting, another event coming up in the beginning of September and some exciting news that we'll share with you at the end before we adjourn at 7:30 at the latest, okay? Wonderful. And we like feedback, whether it's it's positive and you tell us, what a great job we've done, we also like ways that we can improve. So we've put a survey on each of your tables, and Becca will be collecting those at the end. So we would ask you that you fill those out and leave those behind so that we can get your feedback. So without further ado, we've got two of our teammates, two of our CPAs presenting some of the laws. Ron White is one of our CPAs. He's one of our managers. And John Gibney, he's one of our CPAs, and he's one of our relationship managers. And then when they're finished, I'll come in and talk about some of the ways to pay less tax with the new law. So thank you all for joining us, and we're looking forward to tonight.
Good evening, everybody. I'm Ron White. I'm not the comedian, but we'll try to make it interesting. Taxes can be a little, So as you can see, we're going to cover the laws that were in place last year, new laws for this year, and then how the laws can affect you and the changes that are going to take place during the year. All the information is subject to being interpreted differently by the IRS. They've yet to issue guidance. As Russell said, there's 184 pages. I wanted to cover them, but I was outvoted. So we'll just continue on with what we have here and the laws that have changed during this tax process. There's give and take in the new law. They gave us some things, they took away some things. They had to balance the budget the best they could. There's some reduced deductions also to counteract some of these changes in the rate structure and the standard deductions. Some of the additional deductions we're going to cover are the revised individual tax rates and tax rate schedule, increase in the standard deduction, which I'm sure you've all heard about. There's an increased child tax credit. If you need more kids, you can get an extra $1,000. And there's going to be less taxpayers affected by the alternative minimum tax, also known as the AMT. So we'll touch on each of these as we go through the next slides. And the first that we have is the tax rates as they stood. There were 7 brackets ranging from 10 to 39.6%. There'd been talk that they were going to reduce these to 4 brackets, 3 brackets. They ended up with 7. 10 being the low bracket and 35% being, or 37% being the high bracket. Each bracket changed not only by the percentages of 1 to 4%, but the dollar amounts that are affected in each of these brackets changed also. So it isn't just the same dollar amounts at different rates. As you can see on the single taxpayer, we'll run through a couple of these. The low bracket, there's not a lot of change. It's 10%, roughly $9,000 of taxable income, $9,500. Second bracket of 15% does drop to 12, and the rates are approximately the same. If you get into the range of about the 91,000 in for the 2017, at that rate, if that income transpires in 2018, it's about a $2,400 tax savings to a single individual. On a married filing joint, at the 153 level in 2017, you'd be dropping down to a 22% rate, and the tax savings there is approximately $4,000. As you get into the higher bracket up here, almost to the 35%, you're looking at about a $15,000 tax savings from 2018 over 2017. Married filing separate rates are up basically half of the married filing joint rates. And the head of household rates are kind of a hybrid between single and the married filing separate. They have their own separate table to work from. Long-term capital gains rates have their own rate also. Short-term capital gains, as you may know or may not, are taxed at ordinary rates. The rates are based on the schedules that we just went over. But capital gains have their own rates, either 0, 15%, or 20%. And capital gains are taxed at 0 if you're in the lowest 2 tax brackets. You're taxed at 15% if you fall in the next 4 tax brackets, and then at 20% if you're in the highest, the 37% tax bracket. So there's a significant benefit and opportunity there to plan. Correct. Right. They break it down. There is in all of these, there are no real standard calculations. I mean, depending on where your income and the types of income fit together as to what piece of it would be taxed at what rate. Right.
And that's one of the things we're going to talk about at the end, is how to utilize that.
On the standard deductions, again, most of these doubled. Single from roughly $6,300 to $12,000. Married filing joint, 12 to 14. Married filing separately, half of the married filing joint rate, and then the head of household again fits just about in the middle of the other rates of the single and the married filing joint rate. As you can see, it's a significant difference. I know one of the questions regarding how all this is going to affect with itemized deductions and how that comes about. This is a significant increase. As John will get into, there's been some things that have taken away that from an exemption standpoint that would, from your overall tax benefit, may not look as big a jump as this. You could say normally, well, I'm getting 12 as a standard deduction, now I'm going to get 24. But again, there's maybe some things on the other end that may be reduced or eliminated. In increased child tax credit, previously there was a $1,000 tax credit that was available for children if you had a child that was under the age of 17. This credit now doubles to $2,000, and there's a new refundable portion of up to $1,400. So if you ended up with a 0 tax liability and you had children, you would still be able to get up to a $1,400 benefit refunded to you. Previously, it was always against the tax that you had, and it could never reduce it down below 0. Now, a new one, this $500 credit for other dependents. If you really love your in-laws, make them your dependent and have them move in with you. You can get an extra $500 tax credit on your return. It's not a deduction. It is a true credit of dollars coming back to you. Right, as far as this credit, there may be some opportunity, but again, it's an individual situation as to if they don't really qualify as your child, but they do qualify as a dependent because of certain parameters you have to go through. You may be able to get some of that. The alternative minimum tax, this is a tax that was put into place many years ago, and it's been changed umpteen times, and the rates have changed. And it was basically put in play for high income taxpayers, or high income taxpayers that also had a lot of itemized deductions, taxes, miscellaneous deductions. And so this was put in place to kind of take away some of the benefit of the lower tax brackets. And if you got over these limits of 120 or 160,000, some of that income could be taxed at 26 to 28%. And you found that a lot of people in that 200,000, 250 range were paying an extra few $1,000s, and there really just wasn't, because they were doing anything that was really creating a lot of deduction. It was just their normal living, but they had high interest and mortgage and property taxes. This new law, however, is going to eliminate a lot of people falling under this range, as it's going to increase that exemption in amounts of, up to 500,000 and $1 million.
John Gibney, as you said before, I get to give you the bad news portion of this. Like we said, it's the give and take. It's not all bad news though, so we'll go through this real quick and kind of let you know what's happened. To give the greater deductions, they also, the way they described it is how are we going to pay for it, and they said we've got to bring down some of these deductions that we have in order to give you better tax rates and more deductions. The first one, and some of these are going to be related to our questions here, is the exemption. So it's a personal exemption. You've probably seen it on your return. Each person on your return, if it's you, your spouse, any dependents, it was $4,050 each last year. That has gone away basically because as part of the raising the standard deduction. The state and local tax deduction, that is capped at $10,000. So, Douglas, like you said, with New York, high tax rates, high property taxes, high income taxes for a state. You're going to see that a lot in other states that's a worry for them. But people in Florida who may have a lot of income, may have a lot of sales tax and property taxes, that can also affect you here as well, not just in states with income tax. Moving expenses, which isn't exactly an itemized deduction here, but that is gone away unless you're in the military. Only really affects people when they move, but it was a good deduction. And miscellaneous itemized deductions, no longer allowed. Get into that a little further. Limits to mortgage interest deduction, they brought that down a little bit, which we'll describe later. And net operating loss, there's some changes to that as well, which we'll describe. But the good news, itemized deduction phase out is eliminated. I think some of you may have seen this before. We add all up the itemized deductions. I've seen someone say, hey, I had $40,000 of itemized deductions. Why didn't I get to take all of those? And that was part of the law based on as your income went up, they could start phasing out some of your itemized deductions. So that phase out is gone. You will get all of your itemized deductions. Yes, if they're within the limits, which we will get to here, but yes, that is part of the itemized deduction still. So the miscellaneous itemized that I mentioned is, or you may have heard of 2% deductions, sometimes we say, which were ones that you had to reach a certain threshold to get them. But some examples of that were related to if you had business deductions that you're taking as an employee rather than if you had a business. Some people took mileage, licenses, telephone, those such things like that. Bad news, things like investment expenses, fees for tax preparation. We don't like that going away, but that's there. Russell has ways to help you with that. But those are part of the cutting out some of the options on the itemized deductions that have been reduced. So the mortgage interest deduction you mentioned. There was a limit before as well, which was on your loans up to $1 million and home equity loans of $100,000. This was talked about a lot there was a couple different options of where they wanted to cut this. Where they ended up was $750,000 as the limit of the amount of your loan that can be deductible. And they were eliminating home equity loans entirely, but now the discussions have come about that basically if it's related to the construction of your home or expansion, things like that, that can be, the home equity debt can also be deductible. If it's basic repair, probably not. They're gonna, it needs to be related to the
improvement.
Yeah, so we would want to ask that question and make sure we get a good understanding of it.
Sorry, I'm just jumping in.
No, go ahead. So net operating loss, to me, kind of like the alternative minimum tax, sort of a difficult technical thing. But this relates really to if you had a business, losses that flow through onto your personal return that you can deduct. Previously, that could be carried back, counted against an old tax return in order to get a refund, or you carry it forward and you could use all of it, 100%, or use it to wipe out your taxable income 100%. So they just trimmed this down a little bit, said you can't go back, only carry it forward, and you can only offset 80% of taxable income. It does carry forward, but they're trying to limit using it to just wipe out all of your taxes. New law. Let me go back to Ron here.
Business. Here we go. Qualified business income deduction. Oh, you're probably saying, well, this is all about personal taxes. What does it have to do with business? but this law was put into place to help individuals. And I'll get into that for a second. But basically, the new law creates a 20% deduction for qualified business income. Sounds simple, easy. What they didn't include in this after is but, because within certain parameters based on types of income involved and wages paid and or the purchase price of property. So there are a lot of variables that are going to go into this, and it's not just a straight, hey, take 20% of the business income that I have. And to qualify for this deduction, you must have an eligible business. You must be an owner of a pass-through entity, such as an LLC that's taxed as a partnership or as an S-corp, where the income flows through to you and is reported on your personal return, or an unincorporated sole proprietor. So if you're unincorporated, filed a Schedule C on your tax return in the past and continue to do so, then this income would also be a qualifying income. Or if you're an owner of rental real estate, reporting activity on the Schedule E. And John's going to go into a little more detail on each of the individual.
Okay, so this is a little bit of a definition before we get into the next part of why we're mentioning a split. They're the businesses that they say do not qualify. So the 20% deduction, just like Ron had mentioned there, is not available to everyone in all circumstances, as he said, the buts. So they've laid out certain businesses that they put within service that they think of as consulting or something, health law, accounting for us, financial services, brokerage services, which sounds really broad, and to me it is. They haven't, I think they're just starting to come out with nailing down what exactly those businesses could be that fall within there. I've had questions from clients who say, hey, I don't know if my business falls within any of this or not, and until we get really good outlines of exactly which types fall within there, we're not sure, but this is the big deal of figuring out who qualifies within here as a specified service business. The architects and engineers were not exempt at first, and then they came back as they were working on this and they put them in. So you're right. I don't know how lawyers couldn't lobby to get out of this since they wrote the law, but they're in there. So related to this, what those businesses were saying do not qualify for the deduction. However, everyone who falls below certain income limits gets the 20% deduction if you have business income, regardless of what type of business you're in, if you fall below certain thresholds, which is $315,000 for married filing joint. It's half of that for if you're filing single or head of household, other taxpayers. There's a phase out limit within there. You see 315 to 415, where that deduction slowly phases out. But if you're a lawyer or if you're a doctor and you go over those amounts, you're not getting the deduction. So this is a really important thing to be aware of, which Russell will talk about, of how do we make sure we understand your situation to help you, to be sure that you don't miss out on something you could have gotten with a little bit of tax planning, because this 20% deduction can be huge for some people.
Will this cover LLCs?
Yes, sir. Yeah, as long as it's business income coming to you that you're reporting on your personal return. There's other limits which are even much more confusing that you can get it, that are based on wages that are paid with your business, or it could be based on depreciable property, depending on what type of business you're in. So it's not just an easy number of figuring out, hey, what's my income number and do I get it or not? There are a lot of factors that go into it, and we've seen a lot of examples. I could not find one that was simple enough and not too confusing to put up on the board of explaining how it went. It's pretty convoluted, but we are happy to help and understand it, because this is the thing that is making the biggest difference on many people's tax returns if they have business income. And losses can be carried over as well, because how do you get a 20% deduction on a loss? So that's another way that there's a calculation of carrying that forward. So it doesn't go away, but there's there's a few weird little details with that as well.
So this is the new law, and it's simple. So we'll go over some tax planning considerations. So the first thing that we want to be thinking about with the new law is that all of us, no matter what our income situation is, we're going to have a lower tax bracket. So we talk about the concept of tax bracket management. So what we mean by that is some of us are in retirement and we have a set income of Social Security or pension and interest and dividends, and we know what to expect, and our income stays the same year after year after year. Some of us might have a business where our income changes from year to year and fluctuates. And then there's also ways to kind of, in certain circumstances, control your income. So what you want to be thinking about with tax bracket management is what tax bracket do I fall into based on my income? And so we're showing you here the married filing jointly rate schedule, but you want to be aware of what bracket you fall into and what your income range is. Because in certain instances, you can be very close to the next bracket. And I mean, take this for example. If you were at $78,000 or $79,000 in taxable income, and there was a way to make a donation to charity or count some other deduction, that could potentially drop you into a bracket that is almost half of what the other bracket is. So tax bracket management and being aware of what bracket you're in from year to year is a very important concept. That's a really good question. So if we're in tax time, can we do something to affect last year? And we would say at that point, we are becoming a historian and we are reporting on what happened last year. There's nothing more that we can do. So some of you may work with us where we do, in addition to preparing your taxes, we do what's called an estimated forecast of your taxes before the end of the year. That would be something that I think personally is one of the most valuable services that we provide, is to give you an upfront estimate of your tax return next year before the end of the year. So if that situation is going to occur, we can say, hey, before the end of the year, here's some things you can consider. This, or this, that would help you better your situation. Also utilize the 0 rate on long-term capital gains and qualified dividends where applicable. If you fall into one of the lowest two brackets, then your tax rate on qualified dividends and long-term capital gains from the sale of stock or the sale of real estate is taxed at a 0 rate. So, and like you asked earlier, if you say you were going to otherwise fall into that lower bracket that was going to qualify you for the 0 rate, and you had a $100,000 gain on a stock or a real estate that pushed you into a higher bracket, you would get the 0 rate up to the top of the 12% bracket. Standard versus itemized deductions. Many people in Florida own a home, so they pay real estate taxes. They may or may not have a mortgage where they pay mortgage interest. And then we have the sales tax deduction, charitable donations. You asked about medical expenses. With the new higher standard deduction, you want to think about the strategy of which years to lump and clump. So what does that mean? Think about our real estate taxes here. When do we get our bill? We get our bill in November, and we can pay our bill in November, we can pay our bill in December, or we can pay our bill in January, February, or March. So if you're thinking about your itemized deductions, and then some of us are charitably inclined, so we give to our church or we give to our favorite charity. So one of the things to think about based on your situation is where you're at on the itemized versus standard deduction schedule with the new law. And if you're on the border, what you might want to think about is picking the year that you're going to itemize and picking the year that you're going to use the standard deduction and flip-flopping each year between that. The way you would do that is you would pick the year that you're going to itemize and you would delay paying those real estate taxes until January from the previous year. And then when you pay this year's real estate taxes in November or December, so you get 2 years of real estate taxes in 1 year. That could also be the year that you make all your donations to church for last year and this year. Something to think about is lumping and clumping your itemized versus standard deduction. Yes? Great question. So dividends from a common stock, General Electric, Home Depot, Microsoft, or a mutual fund that owns common stocks, dividends from common stock are considered qualified dividends that qualify for that lower rate. Many that are in retirement are looking for income off of their investments. So maybe they own some utility companies or some food companies. All of those dividends are at the 0% rate. The one dividend that's not at the 0% rate is a real estate investment trust. So those dividends are taxed at ordinary rates. Yes. Exchange traded funds also qualify if they hold common stock. If they hold real estate and it's considered a real estate investment trust, then it would be ordinary tax rate. So the other idea with standard versus itemized deductions is, like we said, those clients that are charitably inclined and give to church or give to charity year after year after year. And in some instances, what those clients will do is they are selling stock to have money to live on from month to month, and then they're making a donation to church. Well, what does that do? With the higher standard deductions, if we're selling stock to create a capital gain, that's putting income on our tax return, which we are then in turn giving to charity, which if we are using our standard deduction, we don't even get to take that deduction. So we've actually cost ourselves more tax inadvertently. So a thing to think about is, instead of giving a check to church or a check to charity, you can donate stock or you can donate real estate that is appreciated, and by donating that, you get a deduction of what the value of that stock or real estate is, and the gain goes to the charity, and because they're a nonprofit, they don't pay taxes on that. So that's another consideration, is to give highly appreciated stock or real estate instead of Great question. No, it is not. It is either, if it's coming from a bond or a bond fund, it's considered interest income, so it's taxed at your ordinary tax rate. Or if it's a dividend, then it's back to is it from common stock? If so, it's a qualified dividend that qualifies for the lower rate. Or if it's income from a real estate investment trust, it's considered ordinary income. So it depends, I guess, the yield, where the yield is coming from is going to be the determining factor. What type of investment is it coming from? Yes, sir. And so then you've got mutual funds that are either bond mutual funds or stock mutual funds. Yes. So if it's a stock mutual fund, then it would either be qualified or ordinary if it's a real estate fund. So changes in IRA retirement strategy and Roth conversions. What you want to be thinking about here, what this means, and I'll try to make it as plain English as possible, is thinking about what your old tax bracket is and thinking about what your new tax bracket is. And if you are currently putting money into retirement, what you're funding now, and should you consider a different funding level? Or if you don't have a retirement plan and you're still working, consider opening a retirement plan. And the reason why this is a strategy is if you go back to, let's take somebody that has a rental property or a Schedule C or a business that qualifies for that new 20% deduction. And what if they're in one of those fields that doesn't allow that deduction because they're over the limit? Well, if you could put enough money into a retirement plan to push you below the limit, then you could qualify for the deduction even if you're a doctor or a lawyer. So that deduction could potentially save you enough money to cover how much money you're putting in your retirement and pay for itself. So that's something to think about. No.
Have an employer.
You have to have wages, which are subject to where Social Security and Medicare taxes are being withheld. Okay. So you asked about the RMD. So we were talking about clients that are charitably inclined, and if we think about clients that are taking RMDs, that is a required minimum distribution from an IRA once you're over 70 and a half. So typically those clients are in retirement and they have Social Security. So let's think about, how is Social Security taxed? So the amount of Social Security that you receive right when your income gets around this threshold in general, you are hitting the maximum amount of your Social Security that is subject to tax, and that's 85%. If you're below this level, then maybe 0 of your Social Security is taxable, or in some cases 50% of your Social Security is taxable. So you might ask, what does RMD have to do with Social Security? Well, if you think about it, if you're taking money out of your RMD, that's creating income that goes towards this threshold that then determines how much of your Social Security is subject to tax. So if you're charitably inclined and you have to take an RMD, this is similar to donating stock or real estate to a charity. You can donate your RMD directly to charity. So what does that do? That satisfies your withdrawal requirement, and that income does not show up on the front page of your return, so it does not count towards this limit, and it could otherwise reduce the amount of taxes that you're paying on your Social Security and other income. So that's something to think about. So I do this all the time, so it makes perfect sense to me, but I want to make sure that, we're getting kind of technical here. If anybody has any questions, we're good? All right. Another consideration is the effect of the 20% qualified business income deduction. And the point that we want to make here is, we talked about the new highest bracket is 37%, and if we can properly utilize this new deduction, we could potentially get a married couples tax rate, if they were in the highest bracket, down to 29%, or about 25% reduction in their tax rate. That's significant. Updated IRS income tax withholding table. So the new tax law came out in the beginning of the year in January, and many of you that have Social Security or pension income or a W-2 income and you're having taxes withheld, the IRS has a table that tells how much you're having deducted, how much the person that's paying you your paycheck should withhold from your in income taxes. In January, probably the first, second, or third week, when you got your Social Security or your paycheck, you may have noticed that they reduced the amount of taxes that were being deducted. So the reason why we bring up this point is the IRS will penalize you at the end of the year if you don't pay in enough tax based on last year's taxes. So we're bringing this up because we feel like there's a chance that some clients may, unbeknownst to them, have to pay a penalty this year because their withholding was adjusted and they don't realize that they're not paying in enough. So this is kind of that warning pitfall to look out for, to make sure you're not going to pay any penalties. Because penalties are just a waste of money, and that is the last thing we want you to do is pay penalties. So this is the same reaction I got in the morning, but I actually was sitting with a client 2 weeks ago and was in a situation where they were separated and getting ready to go through a divorce, and this client was going to be paying alimony. Well, right now the law says if you pay alimony, you get to deduct it. And if you're the recipient of alimony, you have to collect it, or you have to pay taxes on it. Well, as long as the divorce is finalized before the end of the year, you can deduct the alimony. But if the divorce is finalized after this year, or even if you have a previous divorce that you're paying alimony and you go back to court and you change the arrangement, any changes or divorces that happen after the end of this year, alimony is no longer deductible. So our advice to this client that we were meeting with the other day was try to push to get the divorce finalized before the end of the year. Oh, that's a really good question. I don't know the answer to that off the top of my head. We're going to have to get back to you on that one. 529 college savings plans. So those are plans that are, think of it as like an IRA or retirement plan for college for your kids, your grandkids. So what happens is, in the past is, you make a contribution to a 529 plan, you designate your son or your daughter or your grandson or your granddaughter as the beneficiary. When they get to college, if they make a withdrawal from that account, the withdrawal, all the gains and all the interest and dividends that account earns are not taxed as long as the beneficiary uses that money for college tuition, room and board, computers. I don't think beer counts, but that's the old rule, is it had to be for college. The new rule is not only can a 529 plan be used for college, it can also be used for K through 12 private school. So that's something that we're seeing a lot of our clients that are perhaps setting up these plans for their kids or setting up a legacy plan for their grandkids. They're utilizing this. Okay, so everything we've talked about prior to this bullet point has been on income taxes, which is, the income you earn during the year, the IRS wants to take their share. the estate tax exemption. So think about utilizing it now or later. So So the old law was an individual could pass away and have assets of 5.5 million or less, and the IRS would not take any of that money. If you pass away with more than $5.5 million, the IRS is going to take 40-50% in some cases. So a lot of clients that are trying to do legacy planning and fall into this situation could potentially face an estate tax when they pass away. The new law raised this limit to $11.2 million per individual. So if you have a married couple, that's $22 million. So that's one of the temporary laws. So that law goes away at the end of 2025. So, you know, depending upon your unique situation, you may or may not have an estate tax issue now. If they haven't made any changes to the law at the end of 2025, this is going to sunset back, and it could even sunset back to $1 million. So what you may want to think about, either now or later, is there's a way that if you don't pass away before 2025 and the law is going to change, there's a way to still capture this $11.2 million for each individual and structure your assets so you can still use them, but you can shelter $22 million from estate tax. So, I mean, you may say, well, that doesn't apply to me. Well, I would say, you may say that doesn't apply to me, but I would ask the question, do you play the Powerball? Are you expecting a inheritance? Well, then this law doesn't apply to you. But you know, each client's different, and we want to think about these things to properly utilize this law if we can. This is kind of the tricky new law that we are still analyzing, but we wanted to bring it up to you. And so the new law, a lot of what you heard is Apple and Google and these big corporations are putting all this money overseas and they're not paying US taxes. So what the government did is they dropped the rate on what are called C corporations to a flat 21%. And this law is one of the laws that's permanent. So for our clients that are in the healthcare, attorneys, lawyers that might otherwise have income that is above the threshold to qualify them for that new 20% deduction, what they may want to think about is if you think about like a dentist office might have divisions of their business. You know, they may have hygiene, and then they may have dental work like cavities and root canals and all that stuff. And then they may also have a lab. And then they may have somebody internally that does all of their IT. Or they may outsource it and pay an outside company to do all their IT. But what you may want to think about for those clients that are in a situation where they might not benefit from the 20% deduction is, should they consider a division of their business to be established as a C corporation so that where they can shift some of their income that is above that threshold over to the C corp so that they can drop below and get advantage of the 20%. It's really technical. It's part of that 184 pages of explanation, but it's something that we're going to be considering with our business clients. And then there's a lot of cautions and watch out fors in that. So we're wrapping up here. So this is just a table that I pointed this out earlier, is proper utilization of that 20% qualified business deduction could drop somebody in the highest bracket down to 29.6%. So, can we file on a postcard? Yes. It's the new tax return is simplified to 3 pages. So I get a kick out of that because I don't envision a postcard being 3 pages. Medical, it is an itemized deduction. It's still set at 7.5% of your income, so everything above that is deductible, as long as you still itemize. Property taxes and sales tax, we still have those deductions, but those are limited to $10,000. And the zero tax rate, that's a great tax rate. We like that tax rate. So you definitely want to be considering that and utilizing that to your advantage. Mortgage deduction, I forget what the question. It decreased, yes. The old mortgage, this is something that's going to affect a lot of people, is the old mortgage deduction was up to $1 million in debt. You could deduct the interest, and you could deduct it on a first home or a second home. And you could also deduct interest on a home equity line. The new law, you only can deduct interest on your primary residence and deduct interest on your home equity loan as long as you use it to improve your main residence. I think you are correct. So don't worry if you're sitting here saying, well, I have a mortgage over $750,000 right now, and I've been deducting it. Susie is correct. You still get to deduct it. It's mortgages after a certain date, and I feel like it was at the end of December. Yeah. So it's mostly new purchases. Does anybody else have any other questions that we can help answer? So the losses in the stock market are treated the same way. They did not change that law. So the way that those work is if you have a loss from a sale of a stock or a mutual fund, you can deduct unlimited losses from stocks against gains from stocks or gains from real estate. But if you have more losses than gains, you can deduct $3,000 a year against your other income, and then you carry the rest forward until you use it. Yes. The dividends would be so you might have capital gains, you might have qualified dividends, you might have ordinary dividends. So that tax rate structure is the same as it was last year. Generally speaking, they didn't mess with investment taxes, other than the fact that you can't deduct investment fees. We talked about tax prep fees not being deductible anymore. For those clients that use the standard deduction, it's really a moot point. You weren't deducting it anyways. For those clients that do itemize their deductions, it is no longer a deduction. So then we would look to your situation and say, do you have a rental property? Do you have a Schedule C business? Because in that instance, what we would do is deduct the tax fees against the rental property or against the Schedule C. It's still a deduction there. Any other questions? Sure. Yeah. So we have clients that so we have another company where we help our clients and oversee and manage their investments. So we have many clients that have IRAs where they're taking RMDs and they're charitably inclined. So what they do is they come to us and they say, I want to give a donation to my church. And so we say, what's the name of your church? What's the name of your, what's the address? And how much do you want to give? And then they sign an RMD distribution form. And then our bank custodian that holds their investments sends the check directly to the church or the charity. And that satisfies. Well, and I think, with your advisor that you all have, you'd be able to go to him and let him know that you want to satisfy your RMD, you'd like to donate it to your charity, and then he should be able to fill out, yeah. Good question. Yeah. So you don't have, it's not an all or none. So, say that the RMD that you need to take is $12,000 and you don't want to give that much to charity, but you'd like to give them a little bit. You can take some and you can give some to charity.
So could we make
Absolutely. So that's one of our hopes, is that we will have meetings with our clients to help them before the end of the year. And so that is absolutely what we would recommend is for those clients that we don't already do a year-end tax forecast, is to consider us doing a forecast and then sitting down and saying, here's where we think you're going to be. Now, what things can we do strategically to improve your situation before the end of the year? Thanks for joining us. And let me just say that you all have a choice in who you use as your advisor and your tax preparer and your tax planner and your investment manager. And so we are very thankful for the trust that you place in us and our firm and our team. And we do not take that trust lightly. So I'd just like to say, from me and on behalf of our entire team, thank you all very much for our very valued relationship with each and every one of you. Hope you have a good evening.